told you there was a way to reduce your tax bill before you moved to Canada while also creating a legacy of philanthropy. Hi, Tiffany here. In this video, I'm going to explain how donor-advised funds work and how Americans and green card holders moving to Canada can use this strategy wisely. I'll show you an example where one decision can create a difference of over $700,000. And stay to the end to find out what to do if this isn't the right strategy for your family. I'm Tiffany Woodfield, a TEP cross-border financial advisor and the co-founder of Swan Wealth Management. I work with US and Canadian clients every day, and over the years, I've seen how much stress tax planning and capital gains hits can cause families with cross-border wealth. So let's get into it. A donor-advised fund, or DAF, is a charitable account set up with a sponsoring organization. You contribute cash or investments, and you'll often get a tax deduction right away. You can recommend grants to charities over time, and the investments inside the DAF can also grow over time. When you contribute to a DAF, the donation is irrevocable. This means that you can't change your mind once you've funded a DAF. The last year before leaving the US may be a high income year. You may have a bonus, RSUs vesting, or business income that comes through before you move. If your income is high, the deduction is more valuable. In the US, you can only deduct up to 30% of your yearly adjusted gross income when you're donating gifts of appreciated property. So, if you donate $1 million in mutual funds and your income for the year is $1.5 million, the maximum deduction you could take that year would be $450,000. You could carry forward the rest of the deduction for up to 5 years. But after you move to Canada, you're in a different tax regime. You may not be able to use those deductions in the same way for US tax purposes. This is because your US tax bill will be much lower. This is due to higher Canadian tax rates and Canadian foreign tax credits. In addition, you may not have to file a US tax return if you're not a US citizen or green card holder. So if you're going to create a donor-advised fund in the US, it's often best to set it up a few years before you move. That way you can use all the deductions while you're still in the US. As a Canadian resident, holding US mutual funds is generally restricted. This is because of securities regulations and tax implications. These funds are only licensed for US residents, so selling them before you become a Canadian tax resident makes sense. Let's say you don't tell your advisor that you've moved, and you keep these US mutual funds. You'll still end up with taxation issues. For example, if you live in BC and you're in the highest income bracket, your US mutual fund dividends may be taxed at over 50%. Capital gains may be taxed at over 25% if you're in the highest bracket. And on top of that, you're forced to realize the gains each year. Let's use a simple example to go over the benefits of using a DAF. Julia is a tech executive who works in Silicon Valley. She's planning on moving back to Canada in 2 years. Julia earns $500,000 per year and has $12 million in investments. $1 million of her portfolio is in US mutual funds. She has an unrealized capital gain of $700,000 on those mutual funds. She'll also be vesting $3 million in RSUs the year she moves. That will bump up her income to $3.5 million. If Julia were to sell her mutual funds while living in the US, she'd realize the $700,000 in gains. She could end up paying over $230,000 in capital gains tax, and she'd be liable to pay roughly $1.6 million in federal and state income tax. Julia gives to charity each year and plans to increase her giving. So instead of selling her US mutual funds, she contributes $1 million in mutual funds to a US DAF account. She avoids paying $230,000 in tax on those gains, and she gets a deduction for the $1 million donation. Remember, you can typically deduct up to 30% of your adjusted gross income when the 30% limit applies. Anything above that can be carried forward for up to 5 years. Because Julia's income is high, she can deduct the full $1 million from her income. At a combined federal and California rate of roughly 48 to 50%, the $1 million deduction could reduce Julia's taxes by around $480,000. Add to the $230,000 in capital gains she avoids, the total benefit is over $700,000. On top of that, Julia set up $1 million in a DAF that aligns with her philanthropic goals. Julia can spread out her donations over the next 10 or 20 years, and she's not donating more. Instead, she's redirecting money that would have gone to taxes. If you don't want to create a DAF, that's okay, but you should still have a wealth preservation strategy for U.S. mutual funds. One common strategy to deal with U.S. mutual funds is to sell them and buy ETFs. In some cases, you can do a rollover, which allows you to defer your capital gains, but that's not always possible. If you're in a state with a high tax regime like California, there may be planning opportunities to avoid state tax on these capital gains. You should speak to a cross-border advisor about your situation. Finally, if you're planning a move across the border and have assets that you want to protect, I recommend scheduling a call with a cross-border advisor. The biggest and most costly mistakes happen when people don't plan well in advance. Schedule a call with a Swan Wealth cross-border expert at swanwealthcoaching.com. Thanks so much for watching, and we'll see you in the next video.